Thanks for listening to A Long Time in Finance with Jonathan Ford and Neil Collins, in partnership with Briefcase.News, the service that brings intelligent curation and analysis to your media monitoring. Hello and welcome to Long Time Shorts, a new series of shorter than usual episodes of A Long Time in Finance, each one of which gives you a quick hit of financials history, from the debt jubilee of ancient Babylon to the latest crypto calamities. In today's episode, I'm going to transport you back in time to a time...
How exciting.
In the 1980s. It's an era almost impossibly remote from our current time, with antediluvian technology, fax machines. Do you remember them?
Yes.
People who'd read papery things called newspapers, which come out once a day. Mobiles the size of house bricks that had to be carried around in suitcases. You must have had one of those back in the day.
No, I had the
very first
handheld ones.
Really?
Fortunately, the battery would only last about a quarter of an hour if you were using it, which was just as well because they were so heavy that your arm was about to fall off by the time the battery went.
Right, so back when you were lugging around your steam-powered mobile phone, a French insurance company called l'Abeille Vie, which means apparently bee's life, dreamt up a savings policy for its rich customers, which it called, rather prosaically in my view, given the story I'm about to tell you, the Fixed Price Arbitrage Life Insurance Contract.
Snappy little title.
Yeah, I thought that was pretty smart.
Yeah.
And it went like this, the contract. L'Abeille Vie, like lots of insurers, sold savings products to its customers, and it had a number of investment funds into which the policyholders could put their money. So there was like a French one based on the French stock market index, a Japanese one, a bond fund maybe, whatever. And once a week for each of these funds, it would publish their prices.
Very forward-looking, I would say.
I think there's a remarkable operation they were running there. But once that price was published, and up to a point, a week hence, when the next week's prices came out, you could notify the insurer, l'Abeille Vie, and switch your money from one fund into another at the previous week's posted price.
God.
Now,
that
interesting idea, isn't it?
Yeah.
Perhaps you can see the floor.
Wait a minute. Yes.
So the floor is very simple. If the fund shot up in the days between one price being published and the next, you could buy into it at its old price, and thus pocketing a risk-free gain. It's called 2020 hindsight investment.
Yeah.
The best kind, I think.
I think so, yes.
So let's
never fails.
So let's say the Nikkei 225, which is the Japanese stock market index, rises 5% during the week. All you as the investor had to do was to tell l'Abeille Vie to move your investments into its Japanese fund at the price before the market moved, and you were absolutely in clover. It's a bit like being able to go back and bet on the Prix de l'Arc de Triomphe after the race is finished. So why on earth would an insurance company do this? You have any ideas? I literally found myself scratching my head on this one.
Yeah, I suppose they hoped that after a bit, the enthusiasm for making a small turn, which is presumably what it would be each week.
That's what they thought, yes.
Their enthusiasm would wane and they'd get stuck in one, or they'd make some technical error which essentially stopped the process.
Well, I think there is some truth in that. I think basically most people who live in the world of money operate on the assumption that fiddling around with your investments is incredibly boring and most people can't be bothered to do it. The argument in this case, I've had a look at some of the stories about l'Abeille Vie and this particular fund and the individual I'm going to talk to you about in a second, who's got the splendid name of Max-Hervé George. The assumption is that insurance companies offered these sort of crazy products because they really wanted rich people's money, and they figured that offering them some sort of privileged sort of feel to the whole thing would make them want to put their money with l'Abeille Vie rather than another insurance company. But in this case, of course, l'Abeille Vie ended up rather wishing they had put their money with another insurance company.
Quite.
So you might ask yourself, why did the L'Abbé V think that no one would ever cotton on and start to actually systematically strip them of all their money? And the answer was that basically the antediluvian era in which we were then operating, where prices on stock markets weren't live, you had to call your broker if you wanted to find out what was going on or send them a fax.
Yeah.
Trades could take days to be processed, and to be fair to L'Abbé V, there were lots of other insurance companies offering equally stupid products. But then technology and history intervened. And as you know, being a man of a certain vintage...
Sorry, speak up, I can't hear you.
The pensions industry and life insurance industry operates over many decades. It's a marathon, not a sprint.
Yes, if only. That's a different
I read this thing. I think the last person to benefit from an American Civil War pension, military pension, died in about 2010, which is the most incredible thing. If you think somebody was still being paid for a contract that was originally set up in 1865. So the very long term of these contracts, in this case, came back to bite L'Abbé V rather quickly. It set up the contract in the 80s. In the 1990s, of course, along comes a whole lot of technological change in the form of something called the internet. More and more people use it. New services are dreamt up to get people to go online. And among those services is publishing real-time financial information. And computers also mean that trading and settlement systems speed up. You might have thought at this point that our friends at BE Life had second thoughts about their business model. But
presumably it was too late by then.
No, they didn't even stop selling it till the end of the 90s.
God, well, why didn't I get in?
No, you're just not paying attention. Anyway, in 1997, L'Abbé V is still selling its policy, which among a certain sort of French cognoscenti is now known as golden tickets, rather like Mr. Willy Wonka's golden tickets.
Well, exactly. It's exactly what they are.
And in that year, the father of a man who will come to play a major part in this story, Max-Hervé George, and the father is a French businessman, took out policies for his entire family, depositing the princely sum of 8,000 euros in the name of young Max Hervé, who was then 7. Shortly afterwards, L'Abbé V, obviously seeing the writing on the wall from this disastrous thing they've done, sell themselves to a British insurer called Commercial Union, which later becomes Aviva. But L'Abbé V also wakes up and stops selling the product, by which stage there are thousands of these things out there in the hands of the cream of French society, including those belonging obviously to the famille George. Basically, at this point, L'Abbé V decides, or Aviva as it really now is, decides they've got to do something to try and draw the sting of this, because they can see that it's going to become a very expensive exercise,
yes,
a very expensive teachable moment for them. So what they do is they do something which is incredibly simple. They write to all the policyholders and they offer them a new contract and 100 francs to sign it.
Compensation.
And almost all of them sign it. They just go
francs.
they just write away these Croesus-like riches in the future for 100 bloody francs. But our hero, Max-Hervé, and his dad, they don't fall for this sort of nonsense, and they basically turn down the new contract and stick with the one they have. And they also start basically combing through the financial pages or whatever, the financial internet.
To find the best switch.
And finding the best switch every week.
Yes.
And for a long time, I think this is pretty much all the family Georges do, is sit at home combing through prices.
You know, they have to work hard to...
No, it's not nothing. And we'll find it gets increasingly difficult for them to persuade Aviva, as it now is, to take their instructions. So they carry on doing this. Aviva, by this stage, having failed to get everyone to sign up to the 100-franc deal, they start to impose new rules. So first of all, they say, you can't just send us a fax for the instructions. You have to send us a letter. And then they say, they want to impose limits on how big the switches can be. But of course, none of this is in the original documentation. And so what follows is an enormously long string of legal cases between not just the famille George, but also some other lucky holders of golden tickets.
Who
basically
are smart enough to see.
They're fighting a rearguard action to preserve the value of their investments. And one after another, these cases come to the French courts and go all the way up to the very Supreme Court, the Court de Cassation. And in each case, the courts rule that, yes, this is a very stupid policy, but it's entirely legal. So Aviva are left basically still holding this enormous bag of disaster.
Well, this ever-growing bag, that's the point.
And Mr. George, Mr. Max-Hervé, nobody really knows how much his policy is worth because Aviva just basically stopped communicating. But in 2007, there was a point after one of these legal cases where they were instructed that they had to calculate the value of it. And they came up with a family claim of about 9 million euros. But the key point was that the compound annual growth rate since 1997, so in the first 10 years of the policy, was 68%. So people have, of course, thrown these numbers forward, assuming that Max-Hervé and his family members are no less shrewd in looking into the past than they proved in the first decade, and said, well, what if it carries on at 68%? And I think the numbers are that he himself could already be worth more than €1 billion. And he, of course, he's still quite young. He's only 33. So he's referred to himself as Aviva's worst nightmare because he could be living for decades.
Absolutely. But surely if the liability is €1 billion, why do they not have to declare that as a material item in the accounts?
No, well, I suspect that they argue that they are still pursuing some sort of legal landmark. But there are some very funny numbers in the Aviva France accounts, which seem to suggest there is a big liability in there somewhere. It's just not very clearly expressed, because obviously they don't want to say Max-Hervé George and friends minus 10 billion euros or something. Otherwise, they will get a bit depressed, and their investors might get a bit depressed.
Well, I think they'd probably just end up just giving him the company.
Well, some people think that's where things are going in the long run, because I will come in a second. But so Aviva, obviously, is holding this absolute disaster, sells its French business in 2020, but it can't sell the liability of Max-Hervé and his friends and the golden ticket holders.
I'm not surprised.
And it has to keep that liability.
Yeah.
And it's not hard. I mean, there's a famous quote from Einstein about how people who understand compound interest receive it, whereas those who don't are doomed to pay it. And actually, well, this could be the greatest ever demonstration of that iron law of the universe. Because let's assume that the 68% compound growth rate holds good. By 2030, if that is true, Max-Hervé himself could have made 130 billion out of his original investment. I think that's highly likely. If that does happen, he will own the company.
I think that's a sort of heroic assumption, really, but it doesn't have to grow anything like as fast as that to overwhelm the company.
You are a tremendous spoil sport.
Yeah, but the interesting thing is that it's such a serious and long-term disaster for them that you'd have thought that it was the thing that they would have to talk about every time they produced accounts, because the potential liability would easily overwhelm them.
The only thing I would say on that is other insurance companies have had the same thing. What they have tended to do is to buy people out of their liability. So they go to Max-Hervé or his equivalent and they say, here's 10 million, just bugger off.
Have they not tried to do that?
No, this is the whole point. They've never made an offer because they say the contract is invalid. So this end game could indeed happen at some point. They will run up the white flag and say, we'll pay you whatever it needs. But the basic problem is Max-Hervé, I think, he's now a hedge fund manager. So I think the negotiations are going to be pretty unpleasant.
Yeah. Quite.
Well, not for him, but for them. Well,
I think they will both have to employ some extremely expensive lawyers.
Yeah.
But it sounds to me, from what you've said, is that they've exhausted most of the obvious legal routes already.
Yeah. So anyway, message to insurers out there: Don't do it. If you ever think about issuing golden tickets, think again.
That was A Long Time in Finance with Jonathan Ford and Neil Collins. Production and editing by Nick Hilton, and our sponsorship partner is Briefcase.News. If you enjoyed the show, please rate and review it on your podcast app, as that will help new listeners find us.